What's up, guys? Welcome back to the channel. In today's video, I am finally going to be comparing SCHD versus COWZ. If you remember, COWZ was the cash flow ETF. So let's get right into this comparison. I'm going to start off with SCHD. As you can see, it's currently trading at $79.01, and I'm on the dividend tab. So I'm going to scroll down. Their dividend summary, current dividend yield 3.39%. Annual payout $2.67, and it looks like their 5-year dividend growth rate decreased a little bit. It's at 11.8%. It was over 13% before, which still is nothing to complain about. It's still an amazing dividend growth rate. They've been growing their dividend for 12 years. So now let's look at COWZ, which is the Pacer US Cash Cows 100 ETF, currently trading at $57.88. And let's look at their dividend scorecard. So they have a lower dividend yield at 1.8%, annual payout of $1.03. However, their 5-year growth rate is insane, 17.41%. That is wild. But their dividend growth is only 2 years. So they really don't have that much time and that much data to go over when it goes to dividend growth. I would love to see what they do after 5 years if they can maintain this growth. But now let's look at the SCHD fact sheet. So SCHD does have an expense ratio, 0.06%. That's really good. So their objective is to track as closely as possible before fees and expenses the total return of the Dow Jones US Dividend 100 Index. Some highlights: it's a straightforward, low-cost fund offering potential tax efficiency. The fund can serve as part of the core or complement in a diversified portfolio. And it tracks an index focused on the quality and sustainability of dividends. And it invests in stocks selected for fundamental strength relative to their peers based on financial ratios. Now let's look at just some other details. This fund was created on October 20th, 2011. And they currently have 104 holdings. Then I'm going to scroll down to their top 10 holdings. They have Verizon, Chevron, Lockheed Martin, Texas Instruments, Pepsi, UPS, Bristol Myers, Cisco, Pfizer, and Coca-Cola. So overall, those are some really good stocks to own. And next, we're going to look at the sector breakdown. So they have industrials at 17.12%, financials at 16.73%, healthcare at 15.9%, information technology at 12.58%, consumer staples at 11.95%, and then you have energy, consumer discretionary, communication, and materials. So overall, one thing I like about SCHD is they have a great sector allocation. They're not really heavy in tech, which is why I love owning the S&P 500 in my 401k and then SCHD in my taxable broker, just because there's not a lot of overlap between the two. Next, I'm going to be looking at the fact sheet for COWZ. So they have a strategy-driven exchange-traded fund that aims to provide capital appreciation over time by screening the Russell 1000 for the top 100 companies based on free cash flow. I'm going to look at the overview. So their strategy: free cash flow is the cash remaining after a company has paid expenses, interest, taxes, and long-term investments. It can be used to buy back stock, pay dividends, participate in mergers and acquisitions. And the ability to generate a high free cash flow yield indicates a company is producing more cash than it needs to run the business and can invest in growth opportunities. So this is just a chart showing you the difference between the average free cash flow of the COWZ ETF, which is 8.54%, and the average of the Russell 100, which is 3.46%. So this ETF has high quality US equities. Their strategy targets US companies with strong cash flows and healthy balance sheets. They are trading at a discount with exposure to opportunities in the market where high quality stocks are trading at a discount. Long-term growth and income. Companies with a high free cash flow yield have the ability to grow dividends over time, but there is no guarantee dividends will always be paid. And so I wanted to look over here and see if I can find their expense ratio. All right, total expenses 0.49%. So that is a really high expense ratio, a lot higher than SCHD's. I want to say a little over 8 times as much. And then they do have 103 stocks, so about the same as SCHD. Now let's see their portfolio, their top 10 holdings. They have Valero Energy, Marathon Petroleum, Vistra Corp, EOG Resources, ExxonMobil, Occidental Petroleum, Diamondback Energy, Devon Energy, Chevron, Lyondell Basel Industries. And then you can definitely see a theme there. There's a lot of energy stocks. However, one thing I wanted to point out that's actually really cool that I really like about this ETF, their top 10 holdings only account for 21.38%. That means they allow their other stocks to also perform in this ETF. Whereas, in the majority of ETFs, you look at the top 10 will be 40, 50% or even more of the portfolio. So now in the sector breakdown, starting off with energy at 24.06%. That's actually, I really like seeing that because even though energy is weighted heavy on the top 10 stocks, the top 10 stocks don't have that high, 40, 50% portfolio allocation. So that's actually really nice to see. Next up, you have consumer discretionary at 17.1%, then healthcare at 13.04%, industrials at 11.98%, then you have materials at 10.56%, and then you have information technology, consumer staples, consumer services, utilities, and so on. One thing I will notice about this is they're really heavy in energy and consumer discretionaries, which could see a big hit in a recession. However, they probably would, I would imagine, do a reconstitution, find different stocks to own that have better cash flows in a recession. But with that being said, let's look at the back test. So I put $1 million. We're going to reinvest the dividends, display the income. And we have SCHD, COWZ, and VOO, the S&P 500. So let's see what happened with this. And with an initial balance of $1 million, we actually see that SCHD is the lowest at 2.3 million, followed by VOO at 2.6 million, and COWS actually outperformed everybody on capital appreciation at 2.7 million. And then when we look at the best years, COWS had the best year of 41.7% growth, followed by the S&P 500 at 31.35%. And then SCHD had the worst best year at 29.87%. And then going to the worst year, SCHD was the top performer at negative 5.56%, followed by COWS at negative 10.04%. And then the S&P 500 was the lowest at negative 18.19%. As you can see, this started at basically January 2017. Then now I want to look at the dividend income, see what kind of story that tells. So right off the bat, we see SCHD in blue, and we know that SCHD in pretty much all of these, comparisons, SCHD always outperforms on dividend income. But we can see right here, 2017, SCHD had a little over 31,000, followed by COWS with a little over 23,000, and then VOO with a little over 21,000. However, in 2018, COWS dividend income went down, and it came up a little bit in 2019, and then COWS went up a lot in 2020. However, it also went back down again in 2021. So it's really showing inconsistent dividend growth. And that falls in line with what they said, that they don't always guarantee a dividend. And so maybe part of the reason they have such the high dividend growth rate of over 17% is the difference between 2021 to 2022. That's a huge jump, over doubling the dividend income. And then 2022 to 2023, the dividend income didn't grow that much, over 10%, probably around 12, 13%, which is still great. So what I would really like to see is where COWZ stands at the end of 2027. So maybe coming into 2028, let's see what COWZ has done, how have they grown their dividend income, and then I want to see with the SCHD reconstitution, what happens with their growth. Will SCHD outperform the S&P 500 again? Can SCHD outperform COWZ? But overall, if COWZ can maintain this dividend growth, even if they just drop it down to 8 to 10%, I still think this would be a great ETF to own, especially with their capital appreciation. Although I would want to see some data on a recession. But other than that, guys, thank you for watching the video, and I'll see you in the next one.